Welcome to the daily update, where I'll go over the action in the market for Wednesday, July 9th, and we'll see how things look for Thursday, July 10th. Before diving into today's video, if you find it helpful, consider a 30-day free trial to the SPX investing program. This trial lets you explore my unique approach to market analysis. Full-length daily and weekly videos are available on a delayed basis after the market closes. For immediate access, become a member by clicking on the link below. And a fairly solid update, maybe not as positive as you would think it would be. We're seeing some improvement. We're still looking at a pretty exuberant market as far as sentiment. We're right at 75 there. That's when we get a little bit concerned. But our charts are still positive on all time frames. And we saw small caps having another fairly good day. So we'll see if we can get a little bit more follow through. Now, the biggest economic report that'll come out on Thursday will be initial and continuing jobless claims. That's pretty much it. It's been a fairly light economic report week. It's been pretty heavy as far as news and all the different things going on. But we're still maintaining this positive stance in that the NASDAQ and the NASDAQ 100 set another new all-time highs. Now, we did not set one with the S&P 500, but we're not that far away from that either. Okay, so right at the open, we did have a gap higher. It looked like, uh-oh, here we go. We're going to have a gap higher. The market folks that get involved right at the open, they're going to be all excited about things, hit the high right after the open, and then go down after that. And it started out that way. But we found some support, and then we were able to, in a more systematic way, start to come back up and look like there was just a more of an established trend. So we did gap higher. We were above R1 at 62.40. We got above R2 at 62.54. We're still dealing with that 62.50 level. And then we stalled a little bit under the 62.70 level. And then this is where we went back. We fell back below R2 and R1. But there was a little bit of a base that was set up there, and we chopped above and below R1 before then finally breaking higher, climbing back above R2, and we closed slightly above 62.60. All right, so we were up 0.61% below average with volume. Again, we're in the summertime now, so this is not uncommon for volume to be below average unless something really big happens. We are positive on all time frames. Now, the big thing that really helped stocks in Wednesday's session were interest rates coming back down. We've been inching our way back up with the 10-year yield, and we were getting close to that 4.5% level. Well, interest rates started to come down. That gave support to stocks. And then, of course, all the geopolitical things that are happening right now, but they're not really having much of an impact on the market other than tariff things coming out, trade wars. But the market's even starting to become more immune to that. Okay, some comments. Both the NASDAQ and NASDAQ 100 set new all-time highs. NVIDIA, and this is something the financial media just loves. It's an easy thing to talk about. NVIDIA has now developed, I guess you would say, or earned a market cap of over 4 trillion. So they're the most worth company in America, if not in the whole world right now. And of course, people love to talk about those kinds of things. There's also this assumption that's going on in the market that better trade deals will be struck and that the tariff actions won't lead to untenable inflation rates or to much weaker growth. That's kind of the prevailing attitude that's happening. Last March into April, when we were really going down, it was just the opposite of that. That we're going to have massive inflation and the economy is going to fall off a cliff. And either one of those could, it could be good or bad. They could happen, but we're not really seeing that reflected in the market right now. But that's why we watch this every day, to see for subtle changes that are developing. We look for those things, and if we start to see things shift a little bit, then we'll be right on top of that. There was a pretty broad advance. The mega caps, specifically NVIDIA, it got a lot of press for going over 4 trillion in market cap. But it wasn't really strong with the mega caps, but they did help lead things. And then the rest of the market also had some advances. And the FOMC meeting minutes did come out. They conveyed a stronger expectation that, okay, maybe we're going to have rate cuts before we're going to have rate increases. And the market took that as more positive. And they're looking at this happening potentially by the end of the year instead of having no rate cuts, because that's pretty much what's baked into the July meeting. We're starting to see a little bit of a shift as we go into the fall and finish out 2025 as far as the Fed getting, or the FOMC meeting, and what they're going to do with interest rates. And now, the short term, the Stochk RSI is still not on the list. So it improved, but it's not really giving us an indication of good, solid, positive momentum. But there are other indicators that do. That's why I look at a bunch of them. The Williams percent R is still showing good short-term momentum. The CCI 20, but the CCI 14, it improved, but it's not there. The stochastics are still extreme. And then the momentum oscillators, the short-term one, the slope oscillator, that's still looking extreme. It's still positive. We are still far away from the 20-period moving average, and now the short-term RSI is back on the list. Intermediate term, we have the TTM squeeze. That's starting to get extreme positive. We're still in the +3 channel with the standard deviations chart. We're still looking extreme with the rate of change going back 50 periods, and then our intermediate term oscillators are also looking extreme, as is the Sean trend meter. We also are far away from the 50-period moving average. And the bullish percent indexes, both for the S&P and the NASDAQ 100, are extreme, but they're still positive. And then even the intermediate term RSI is now back on the list. No real changes to the scenario other than they're leaning more towards rate cuts than not cutting rates. And the market is taking that as positive, but that's really not an overall change to the scenario. The dollar was pretty much unchanged on the day. It's been bouncing up a little bit, but by the time we closed with the stock market, the dollar was virtually unchanged. And interest rates did fall, and this was a pretty big fall. We were at 4.42%. We were heading up to that 4.5% level. Well, now we fell all the way down to 4.34%. That's a pretty big move for one day with the 10-year yield. We're still extreme as far as sentiment. No change there, but we're coming in at 75, and that's when we are a little bit too exuberant about the market. As far as the trend, we are positive. The green line's above the red line. We're above the moving average. We're above 20. So that's still showing a positive strengthening trend. And the bias is positive with the up day. And the momentum continues to be positive as well. That's the last 2 or 3 or 4 or 5 days kind of taken together. All right, so we had the MBA Mortgage Applications Index. Nice little surge here, up 9.4%. Last week it was up 2.7%, but not a real market mover. And wholesale inventories were, as expected, they were down 0.3%. Last time they were up 0.1%. Not seeing a real big change there. So here is the chart of the mortgage applications, seeing a bit of a pickup there. Even though interest rates have been going back up, and mortgages, they're really tied to the 10-year yield. So we'll see if we have a drop off of that coming up next week. But we are seeing a bit of an improvement as far as the mortgage applications. This is another way of looking at that, where from 2022, when we were going through the bear market, we saw, I can't buy a house now, I can't refinance now. And then it kind of leveled off, and it's finally starting to break out a little bit and show some improvement. And wholesale inventories, it had been positive, but declining going back to the beginning of the year, and now we're starting to turn negative. Now, if this was going up, that means that companies they're making stuff, but it's not going out the door. Well, this shows that it is going out the door in a very generic way of looking at this indicator or economic report. Okay, and I have a few extra charts here today. I spent a little bit of time on X looking for things, and I'll show this again in the weekly video update over the weekend. These are active asset managers. It's called NAME, and they manage money on the behalf of others. and it says they buy tops. I mean, they're emotional. They have peer pressure. They have clients that they have to answer to. And when the market's really going up and they're just sitting back saying, I'm not doing anything right now, that's not good for their business. So what they do is like a lot of us, we all act by our emotions. When the market's really going up, they tend to get in. And now this reading is a little bit older here. It's coming in at 99.3. That's what we had for last week. We'll see if it's continuing to go up. But we use this as a contrarian indicator when we get to a really high reading, specifically above 90. And don't be scared of heights. It says usually when we have new highs, that's followed by more new highs until we see the last one for a while. And this just shows 1 month, 3 months, 6 months, 1 year going out, the percent of the time that we're higher, and the further out you go, the better it is. And also the better the returns are along the way. Strength tends to follow more strength. Okay, then announced buybacks. We're well above that now. This is the black line where we're at up to this point, and then going back over the last number of years. And this is also seen as a sign of strength when a company is willing to buy back its own stock. And now this goes on their books and it helps their numbers, their bottom line look better, but it also takes a lot of shares off of the market, and they're seen as more precious, and they tend to go up in value then. All right, then the risk appetite, folks are getting a little bit more willing to assume some risk, and folks are also still thinking that we're going to look pretty good going out into the future. And then we break that down. This is like the second part of that chart. What is your sector outlook for the next 30 days? They see financials doing the best. Now, right now, we're a little bit concerned about that, and I'll show you later on with a chart. We have a ratio of the financials to the S&P, and that ratio is coming back down to its 200-day moving average. And financials are doing okay, but they're starting to underperform when we compare it to the S&P 500. And then you have tech, that's the big growth area, communication, another growth area, industrials, again, driven more by what's happening with the economy, and utilities have still been strong. And I mention this quite often. Usually utilities are seen as defensive, widows and orphans. These are the kinds of stocks they want to get into because they're safe and they have dividends, and everybody needs to have utilities. Well, you can also make a case that it's a growth area because of the huge growth in AI and electric vehicles and all of the power that is needed for crypto mining and things like that. So they're seeing these areas as being more solid, but healthcare is still lagging behind as well, where they're still seeing discretionary, which has actually been improving. The perception here is that it's actually going to be one of the worst performing areas. Okay, then equity positioning across all the sectors. This just breaks down the basic 11 sectors in the S&P 500. And where's the money going? We're still seeing money going into utilities, staples. That's more defensive. And then the other areas, we're actually seeing some positioning outflows here. And then the exposure to equities, as we've been coming up out of the April lows, that's continuing to climb. And then after the idiosyncratic tariff impacts, we see earnings growth accelerating slightly from 8.7% up, or decelerating, I'm sorry, from 8.7% to 7.6%. So we are seeing things slowing down, but there's other folks that see it slowing down even more. Now, if we suddenly start to get into a more positive environment, you would probably see a lot of these projections start to turn up. And we have been in a more positive environment already. And household leverage, this is interesting. Liabilities to net wealth is the lowest in years. Okay, so it's kind of interesting how that's changing. And then growth expectations, we're seeing a bit of a disconnect here. The bond market continues to price the next Fed move to be a cut with the expectation that growth is slowing down. That's what the bond market is seeing. But the stock market is trading cyclicals. They cycle with the economy. So they go up when the economy is doing better, and they go down when we're having economic weakness relative to defensives. Defensive is what, toilet paper, toothpaste. These are what investors and money managers get into when they think the market's going to go down. So we're seeing a bit of a disconnect in that the bond market is basically looking at the economy slowing down, with the stock market thinks that it's going to continue to grow. Okay, we'll see how that continues to play out. And then melt up talk, despite equities reaching new highs, there's little evidence of irrational exuberance. It, we can see that when we've been setting all-time highs recently, before the July 4th weekend and so forth, we're seeing it on lower volume, and we're not seeing like a blow off top. But we are seeing a lot of buy the dip that's coming in, and so far that's been helping to hold up the market overall. So this is pretty subjective here. Somehow they might have standardized this. The melt up story count. They look through financial media or watch videos or whatever they do. There's really no idea how this is put together. There's no methodology that I can figure out from this, just from looking at the chart. But it's actually going down as far as the stories that, oh, we're near a top. Oh, get in now. You're going to have to, you'll be left behind, while we're seeing the year over year change in the S&P continue to improve. All right, and then earnings expectations for the second quarter fell sharply after Liberation Day, more than any of the previous 5 quarters. But the fall is over, and forecasts reported to Bloomberg showed an uncharacteristic slight increase just after the quarter end. So we are seeing an improvement to the earnings per share. But see, a lot of these tariffs haven't even kicked in yet. It's the market trading off of the news that they might happen. And July 9th was the deadline, and now a lot of that's been pushed out to August 1st with the hope of some trade deals being put in place. So a lot of what has been happening really hasn't come through into the economy yet. But everybody's willing to speculate on what's going to happen there. All right, macro conditions. The overall equity movement is perceived as occurring in one of the most favorable macro environments. And a lot of times, this is why we watch the dollar. With the dollar going down, that tends to help stocks. And that's what it's been doing. Narrowing credit spreads. We also look at the spread between risky and not as risky bonds. That's actually been showing less fear, and that's more positive for the market. Subdued inflation. Still, I mean, it's not down to the 2% target that the Fed wants, but it's still not raging like we were seeing a few years back in 2022. And interest rates remaining below 4.5%. And we were getting close to that. And I was trying to bring that up in the videos. At least in Wednesday's session, we're starting to come back down. We'll see if that can continue. And so this is making it more favorable as far as the macro conditions, the big picture of the economy, and ends up doing better for stocks. Okay, short interest, percent of the market cap for the top 10%, the most shorted stocks. These are people that they make a profit when we go down. They sell to get in, and they have to buy to get out. And we're still seeing that continuing to be high, but not astronomical at this point. And then earnings per share growth. This is the same chart. I guess I had this on here twice. So in case you missed it the first time, here's another look at that. I get some of these charts from different sources, so I overlap that. Mastering the stock market is challenging and can take decades to achieve. Most beginner traders and investors feel overwhelmed and often fail. Stay ahead with the SPX investing program. Members gain access to the full program. Other options include immediate access to videos as they become available. Alternatively, the daily and weekly newsletters may be helpful. Click on the link below to find out what's best for you. All right, so then looking at the intraday chart, it looked like, okay, here we are off to the races, and we gapped above R1, R2. We set the high right after the open, and then here we go. We really started to fall back, but we were able to build a bit of a base here right below R1, and then this is more of a gradual approach as we were going into the close, which is a little bit more positive instead of these big spike up and spike down and going all over the place and going crazy. And we are down a little bit in the initial overnight session, down about 0.25% as I started recording this. We'll see if we get more carry through into Thursday's session. We are improving here with the blue line going farther above the red line on the intraday growth to value chart. And we are improving this way. We fell off a little bit. We spiked up and then just kind of held on to those gains. So we're coming back into this higher range that we were coming up from. And then we had July 1st happen where this ratio really went down. And now it's been trying to improve ever since then. So end of day growth was up more than value for the large caps, mid caps, and the small caps. So our end of day chart still hanging in there with the small caps. The mid cap chart is hanging in there, and the S&P growth to value ratio continues to look stronger. We're still above most of the rainbow with this growth to value ratio. And then discretionary is improving. We're getting really close to a golden cross here. We're not quite there yet. And we're seeing discretionary starting to outperform staples now, where discretionary is seeing a bit of strength there, but we're also seeing some weakness in staples. Staples are more defensive, and when these are going down, that tends to be more positive for the growth areas of the market. And discretionary is one of the growth areas, and we like to see that going up in a more positive environment. And here's the large cap growth ETF setting an all-time high above all of the moving averages. And this is actually more positive when this ratio is going down. This is value to growth, which we're just looking at the tech sector. And that is more positive also. Here's our trend in the short term. Green line above the red line, positive. ADX, the dark line here, above the moving average and above 20. So a short-term positive trend. Also, a intermediate term positive trend as well with this chart. And we are below average with volume, and we can see that we are dropping below the moving or the average for volume. And then here's some different sentiment readings. Market sentiment returns to euphoria, getting very high readings here from Yahoo Finance. And that's actually confirming what we're seeing in some of the other sentiment gauges that we follow. Also, really bouncing back up here. Now, this is back at break even, but the context is that it has been improving. This is when we were setting the lows back in April, and then we've been coming back as far as sentiment on this particular gauge put up by Goldman Sachs. And we're below 20 and declining with the VIX. We're below the moving averages, so that's showing an improvement there. We're also below the moving averages with the VIX of the VIX. And a little bit of a contradiction here. We declined with this particular fear gauge, and we're actually ticking up a little bit with this other fear gauge. And we saw a big move up here. This is kind of interesting. That means that more puts were bought than calls in Wednesday's session when we see the daily chart really start to go up. That means they're concerned about something, the people that do this. And so we're starting to go back up with the 5-day chart, and we're just ticking back up slightly with the 10-day chart. This is still positive. When this ratio is going up, that means the market is more risk on. They're willing to get into what's considered to be the riskier stocks because it's risk versus reward. If you have more risk, then your potential for reward is typically greater. And we're also going up with the high beta to low beta ratio. This means the market is more offensive rather than defensive. And still above the band, kind of chopping sideways a little bit. The volatility risk premium's been a bit elevated, but it's not really moving all that much lately. And we're looking good here, but not setting highs with the advanced decline line based on price and volume, but still above these advancing moving averages. We are coming down after being extreme with the advancers decliners oscillator. It'd be more helpful if this was to turn and go back up, but it's not starting to do that yet. And a little bit of a tick up, still above zero with the short and intermediate term advanced decline ratio. And then we have smart money indicator number 2 here, the Chaikin money flow. That is positive. The Chaikin oscillator is still negative, though. It turned up a little bit, but it's still below its moving average. And we're looking positive with the vortex. We see the green line going up and the red line going down. Looking fairly good here with the new highs, new lows, although they are starting to come down, and that's rolling the 5-day over and starting to flatten out the 10-day moving average. And then this is in a little different spot. We're improving with accumulation distribution in the short term. It's starting to turn up, but we haven't quite crossed back above the moving average. But we are positive since we're above the advancing moving average here. And this is longer term, a 10-day average of the highs and lows for the S&P, still hanging out around this green line. That's more longer term positive. And the advanced decline lines across all the different indexes, they are above advancing moving averages. And I haven't shown this in a while. This is an apples to oranges comparison. The apples being the S&P 500, the oranges being the NYSE advanced decline line, and both are improving and moving more in lockstep. And this is another broad market measure, a 5-period moving average of the highs, lows, above zero and continuing to advance. And didn't see much of a change here with those stocks in the S&P above their 20-period moving averages, but it's still positive. And a little bit of a tick up with the 50-period moving average, 100-period moving average, and 200-period moving average studies. So here we go. We're not back at an all-time high yet, but we're still maintaining, for the most part, a series of higher highs and higher lows as we've been coming out of that trendless environment that we were in for quite some time. And on the bottom, we were below average with volume. So a little bit of a turn up and still looking positive though with the 20, 50, and 200 period moving averages on the S&P. Turning back up with the Stochar RSI, but not above this 0.8 level yet to show that it's more solid upward momentum. But we're still there with the Williams percent R. That's suggesting good positive short-term momentum. Still below this extreme level with the CCI 14, but we're just a little bit above it with the CCI 20. And we're turning back up with the short-term stochastic, still declining but extreme in the intermediate short-term, still below the moving average but extreme with the long short-term stochastic. And as I always say, this is just a further subdivision of the short-term time frame. Improving but still below the midpoint with the force index. The short-term trend still looking solid. The green line and the blue line continue to go up. We're still in the +3 channel with the standard deviations chart. We switch over to the intermediate term, balance of power going up and above zero. That's positive. Above all the plotted moving averages here, the 10, 20, and 30, and all the lines are continuing to go up. That's a positive for the trend. And the go, no go continues to be darker blue. That's positive. And we're not quite back up to the blue line here, which is the highest high value, but we're still above an advancing midpoint. And we are getting a little bit long here, according to the Landry Light. Now, this is positive, but the way this goes is when this lasts for a certain period of time, when we start to go above the dashed line, maybe it's time that it's getting a bit exhausted. But we are still positive with the proper order. TTM squeeze just a little bit above this black line here, meaning that we're getting extreme positive. Declining, but still above this 10 level with the rate of change 50, so that's extreme positive. Still just kind of hanging out above zero here with the ease of movement. Not seeing any real conviction there. Decline, but still positive with the Arun. The oscillator is above zero. That means there's more buyers than sellers. And a little bit of a tick up with the S&P McClellan oscillator, but we're still above zero. So when this is above zero, we're still going up with the summation index based on price. And we were leveling out and slowing down just a little bit here based on volume, but it's still advancing. And a little bit of an improvement, but still above zero with the NYSE McClellan oscillator. So we're continuing to go up with the summation index based on price and volume here. But we're declining with the Swollen Trading Oscillator. We had an update, but it's still picking up some negative things according to how it's calculated. And extreme with the PMO above its moving average. It's extreme because it's above this red line. Rolling over just a little bit, but still positive based on price as well as volume. And a little bit of a decline, but still above 50 with the PMOs that are rising. See, this should go up if we're seeing some more internal strength inside of the S&P. And actually, it's declining a little bit. We're actually coming down a little bit, but still above 50 with the buy signals. And we're flat, but still looking pretty solid. Slightly below this green line with the PMOs that are above zero. We're still neutral though with the Elder's Impulse system for the S&P. We're still positive with the parabolic SAR. And we're extreme since we're above this green line with the slope oscillator, but we're above the moving average and continuing to advance. The MACD, still above its moving average, but not showing a lot of strength currently. So the short and intermediate term oscillators are continuing to be positive, but they appear to be slowing down just a little bit here. Where the longer term oscillators, the TRIX and KST, they're starting to turn positive, but they're already near extreme positive territory. But we are positive with the Copic Curve Momentum Oscillator, and we were flat, but still looking positive with the Sean Trend Meter, still above 50 with the Money Flow, ticked back up above 50 with the Ultimate Oscillator, still above the moving average with on-balance volume, starting to get extreme with the intermediate term RSI and the short-term RSI. An intermediate term trend condition based on 50 periods, the red line and the blue line continue to go up. So that's still looking positive there. We're still above all the moving averages that are on this chart. That's positive, but we are far away from the 20 and 50 period moving averages. And we're still going up slightly, not as much, but the bullish percent index continues to be above its moving average and climbing. But we're in this extreme area. There's not an awful lot more that this indicator could go up here. And we're continuing to improve with the NYSE bullish percent index, also above the 70 level with the bullish percent index for the NASDAQ 100. So that is also extreme, but it did go up as well. And we're still getting a praying bottom fisher. I'm not quite sure what bottom it's finding here other than that sideways action that we had. But this is still producing a buy signal, but we don't act on this just alone. We use other charts to confirm what's going on. And the weekly chart, we're still down on the week. We're down 0.26%. So we're going to have a positive Thursday and or Friday to get us back up to having a positive close on the week. But from a trend perspective, showing some improvement here with the Heikin Ashi with the open candles. We're back to pointing up with the Kegi chart where we were black, but pointing down yesterday. And we're still positive with the Renko chart, and we're positive with the three-line break chart. So the trending charts that we follow are back to looking more positive across the board there. We're seeing strength here with the 150 and 200 period moving average study. Still negative in the short term with small caps. For some reason there, we're above the 200-day moving average. So I'm not sure why that one's pointing down. And we're actually looking better with bonds. There was such a decrease in interest rates, which means price went up. We switched over to being positive in the short and intermediate term, where commodities are still positive across the board. And even though the dollar's been stabilizing, it's still negative on all time frames. And we look at the utilities. That was the strongest area. Then we had tech doing okay. Discretionary was up as well. But then it was real estate was down slightly, energy and staples. And these are considered to be more defensive areas quite often. And they were the areas that underperformed. Nothing but green here. We did the S&P, and that was an intraday high that was set there on the S&P. We didn't set a new closing high. And then the NASDAQ setting a new all-time high. And what's not on here is the NASDAQ 100 as well in Canada. Set another new all-time high. So we're seeing more green, especially in the growth areas. Tech, the big boxes are green. Amazon was up. Tesla was down, but not by very much. Communication, we had Google and Meta and Netflix all being up as well. And that's what helps drive the indexes higher. We are improving, but we're not quite back to a golden cross with the Dow. We're still neutral with the Elder's Impulse system for the diamonds. And setting a new all-time high here with the NASDAQ. And looking positive with the Elder's Impulse system for the NASDAQ. NASDAQ 100 also setting barely, just a new closing all-time high there. And still neutral, though, with the Elder's Impulse system for the Qs. But the momentum is just kind of blah, 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 floating along sideways in danger of actually dropping below the moving average. And still dealing with this long-term trend line on the weekly chart of the NASDAQ 100 going back to 2009. Now, as we did before, back in 2024 and late 2023, we can go above this line. So we'll see. I've been thinking that maybe this would act as overhead resistance, and it still might. We still haven't really cleared this line yet. So that's why I keep showing this particular chart. And we look at the ratio between the Qs, the NASDAQ 100 and 3 to 7 year bonds, really improving here, but not at an all-time high yet with this ratio. And we're not at an all-time high with the equal weight. We're not far from it, but we're not setting an all-time high. But when we look at the QQQ equal weight, that is setting a new all-time high. Now you can see that is negative, where the Qs are setting an all-time high, but the S&P equal weight is not. Or you can see this is positive. Oh, look at the Qs. They are setting an all-time high. Maybe that'll drag the S&P equal weight along for the ride. Here are the small caps coming back above their 200-day moving average with the S&P 600, still well above the 200-day moving average with the Russell 2000 small caps, and positive with the Elder's Impulse system. And kind of going sideways. Not really seeing a lot of strength here with the mid caps, but they're hanging out above their 200-day moving average, but they're still neutral. When we look at the Elders Impulse system, the Wilshire not at an all-time high here, but still looking positive and holding up fairly well. Not quite back to an all-time high with the total U.S. stock ETF. Financial sector pulling back a little bit here, even though it was up over 1/3%. We're still looking at a pretty solid uptrend. This is the concern I'm talking about. When we do a ratio between the financial sector and the S&P, we came down to the 200-day moving average and then started to bounce up off of that. Now we're coming back down to the 200-day moving average again. Now, are we going to fall below this? That might be a little bit more negative. Or is this going to provide support yet again? And the FANG index is setting a new all-time high and in a pretty solid uptrend. This is the tech sector, the 3 to 7 year bonds, setting an all-time high, showing that tech is outperforming. So Apple was up a little over 0.5%, but still in a downtrend. Starting to generate a golden cross here with Amazon. It was up 1.45%. Microsoft back to a new all-time high after a recent golden cross. Google still above its 200-day moving average, up 1.3%. Meta not back to an all-time high, but a recent golden cross here. It was up 1.68%. NVIDIA setting a new all-time high after a recent golden cross here. And Tesla still underneath both moving averages. It was actually down 0.65%. Netflix not back to an all-time high yet, but still a really solid looking uptrend here. And then the ratios between staples, defensive, and tech, which is growth. This is continuing to go down, which is positive. And we're continuing to go down when we look at staples versus the S&P. That is also positive. And turning down a little bit, but still fairly strong with the correlation between U.S. and world stocks, and drifting down just a little bit, but still fairly strong when we look at the longer term correlation. Semiconductors, recent golden cross, setting an all-time high with the Dow Jones Semiconductor Index. The semiconductor ETF that we follow, recent golden cross, setting an all-time high. And we're also breaking out here with, this is that same ETF, the SMH. It's well above the rainbow and in a pretty solid uptrend. Wanted to look at retail, which continues to underperform the S&P. The top chart here is a ratio, where the middle chart, this is retail itself, and we're just about ready to see a golden cross here. We've been hanging out above both moving averages, which is showing the trend starting to improve, and we're still above 50 here with the RSI. And then here's some other ratios. When you look at the weighted discretionary to weighted staples, we're not really breaking out because Tesla is dragging that down because they have such a huge impact on the sector calculation. Where we're seeing an improvement is this is the same chart that I showed earlier. This is a equal weighted version of discretionary to staples. That's starting to improve. That's looking a little bit better. And then tech to utilities also is improving. We're seeing a big breakout here with biotech. That's growth versus the healthcare sector. And overall, a bit of an improvement here with hotels to the utilities ratio. And then bellwether areas, looking more solid here with the semiconductors. The home builders are showing some improvement, but they've got quite a ways to go before we saw that weakness back in late 2024. Kind of going sideways right now with the transports, sideways with the retail, and regional banks are improving, but lately they've been just going sideways. Oil was up, and it's getting more into the upper end of the 60s now. Here's the downtrend of the dollar on the daily chart, even though it did bounce up. It has it down here, but this is trading virtually 24/6. I go based on what was the dollar doing at the close when the stock market closed. And here, why is the NASDAQ here? That's an old chart that should have been done away with. Okay, I have some charts that should have been deleted here that I'm going to have to go through quickly. And I don't want to go back and re-record this. Okay, so I apologize for that. I was paying attention to a news story and I kind of got distracted with everything there. Okay, man, looking at the Truflation reading, we're coming in at 1.67 here. That's still underneath that 2% level. We did really drop. This is the 10-year yield coming down here. And we were getting concerned because this yield started to go back up. The fact that it came down did support stocks. And we are improving a bit here with the 10-year based on price. And we're going back to being inverted again with the 10-year to 3-month yield curve. So we just keep an eye on this because this might point to some recessionary concerns according to this yield curve, where the 10-year to the 2-year, that's still doing okay. And we're looking good here with the Qs to S&P, but we're not looking good with discretionary to the S&P. We are looking good when we compare large cap growth to value. So we're slightly above the moving average with the large caps, mid caps, and coming back up to a declining moving average with the small caps. Still going up for the most part with the S&P to utilities ratio. That's positive. So what's the outlook then for Thursday? We're positive on all time frames, and we are trending. The big report's going to be initial jobless claims. That usually is kind of, well, all right, just another report that's released every Thursday. It's kind of the main one for this particular week. And then all the different geopolitical things as well as domestic things that might have an impact on the market. And then we'll get the Treasury budget, not a big market mover. It actually comes out later in the day. So it's been a pretty light week as far as economic reports. And there will be a 30-year auction. Now, the 10-year auction seemed to go pretty well, and that was also helping bonds to go up and interest rates to go down. But the jobless claims, and then we're going to get a 30-year bond auction in Thursday's session. Seasonality, neutral to positive with the Dow for July 10th, where we're positive for the S&P and NASDAQ. And showing during post-election years, the green dashed line, that's the S&P. And this is the positive seasonality that we tend to see going up about into the middle part of July. This is that same chart, but without all the extra writing on here. Also showing the positive seasonality that we're in right now. The first half of July is the best half-month performing part of the calendar going back to 1950. And here is also showing for the NASDAQ some positive seasonal. With each video and course, members learn to implement the consensus approach, a unique analytical method. Unlike relying on a few indicators that eventually fail, this approach overcomes analysis paralysis by using the weight of the evidence to draw conclusions. Developed over decades across all market conditions, explore the SPX investing program and start with a 30-day free trial. Strength there. All right, so we're still not quite at a golden cross with the discretionary to staples ratio. We're still declining with the Swindler trading oscillator, and the long-term special K chart continues to be negative. And then pretty long list here. Now, the boom indicator hasn't quite switched back over to positive when we look at accumulation distribution. But if you look at the indicator itself, it is positive since it's above the moving average. The Chaikin money flow is positive, and we're still negative with the Chaikin oscillator. So we're getting some mixed signals with our 3 smart money indicators. And the long-term growth to value ratio for the S&P is still positive, as is the McClellan, the McClellan oscillators and summation indexes for the NYSE and S&P 500. The parabolic SAR, the bullish percent indexes, a little extreme for the S&P and NASDAQ 100, but still positive. The oscillators are positive, and our ease of movement, money flow, ultimate oscillator, and vortex continue to be positive. The financial sector is positive. We're a little bit concerned that it's starting to underperform the S&P on a ratio basis. And then the momentum is pretty much flat. It is in danger of actually turning negative with the NASDAQ 100. And then the Pring bottom Fisher buy signal, which I just mentioned here, but we don't use that and say, oh, here we go. It's just one of many charts that we use to make decisions. Here are the pivot points for Thursday's session, which are updated on the YouTube community tab. So our conclusion, haven't changed. Positive on all time frames, recent golden cross, longer term, and we are trending. Thank you. Have a really good day on Thursday, and I will talk to you in the next video.